Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And on today's show, you are in for a treat. I had my friend Charley join me on the show. Last episode we did, he asked me a whole bunch of really great questions, and we kind of followed that same theme today. And we actually hit on a topic which I love and I'm so passionate about, and it's something that property investors do not think about, and that is modern portfolio theory and the efficient frontier. So we tackled questions like buying cheap versus buying expensive, will apartments and units have their day, and investing in areas with stigmas. But we really approached it from a different angle, and that is what, as I mentioned there, modern portfolio theory and finding the efficient frontier. And if you can start to understand these concepts, you will become a far better investor. You will achieve the things that other investors can't, because you'll be thinking about it in the right way, not in a dogmatic way. And we really dig into that in this episode. So I'm super excited for your feedback on this show. If you have any questions, or you want to provide any feedback, or if you want to let me know what you think about this episode, just send an email to til@dashdot.com.au. So that's TIL, which stands for the Investor Lab, TIL @dashdot.com.au. And of course, if you think that this episode is good, if you think this episode is valuable, please make sure you share it with a friend, family member, or loved one, because there is some dynamite in here. And I'm not just saying that because I said it, I'm saying that because most people don't think about it like this. So use this as your opportunity to expand the minds of the people that you love and send this to them as well. But without any further ado, let's get stuck right into it. I can't wait to share this with you, and I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me today again is my pal, Charley. Charley, we had so much fun on the last episode where you got to interrogate me about a few different things that were on your mind. So we decided to do it again. Welcome back. How are you?
Thank you for having me, Goose. I'm well. I will say, though, based on our last conversation, you've spun my household into a completely different paradigm. Just some of your answers triggered some very interesting conversations. Seems like we're getting the itch to make some moves. So appreciate it.
Nice. Well, look, I'm glad to be of service, and I'm glad to stimulate. I love stimulating different ways of thinking and stuff. So if that happened in your household, Charley, then mission accomplished. I'm so stoked with that. So I'm really excited. I know that we're going to be tackling a few things today, and I'm really excited to get into it. So where do you want to start?
Yeah. So again, this is all just based on things that I really secretly just want to pick your brain about and understand that I think the audience is going to benefit from. Yeah. So I'll mention where this has come from, because I think it helps set the context, and then we can dig into these questions I've prepared, because I think it will be a powerful thing to understand. So commonly what we see in the property industry or investing property industry is that there's these camps, right? You'll come out and someone will be like blue chip, or then someone else will be like regional, and then someone else is cash flow, and someone else is this, and don't invest in this area, but you should invest in this area. And I think for the common person like me that is investing, it can be very confusing, and it can also be very, very hard to form an opinion when you're not doing this stuff all the time and understand the thinking that went into it. So I've prepared some things here, and the first one I want to come out of the gate in, I kid you not, in the same day, I listened to two podcasts where one said, you should be trying to buy cheaper properties. So this is properties primarily under 400,000. And then on the other end, I listened to another one that said there's nothing good to buy under 700,000, and even $1 million is the new base. I was like, well, what a difference that is. So Goose, from your perspective and opinion, how do you feel about the difference between buying cheaper properties versus buying more expensive properties?
So firstly, I just want to say that anyone who has a dogmatic approach is getting it wrong. Right? I'm just flat out prepared to say that. So if anyone sits there and says you need to buy X, you need to buy properties over $1 million, they're wrong. If anyone says to you you need to buy properties under whatever $300,000, they're also wrong. Right? Now that is not to say that they are absolutely wrong, but that they are generally wrong. Okay. Because what it all comes down to is understanding what's called modern portfolio theory. So that's an economic theory of portfolio composition. Okay. So if you think about like the biggest hedge funds and all of these kind of like, super multi-billion-dollar organizations, what they do is they map their portfolio based on the risk return profile. Okay. And so essentially, the graph that you end up with, right, is you end up with a an x and y axis, and then there's a straight diagonal line that goes up to the right, and that represents the capital allocation on a risk-free rate of return, right? So as if you could find a risk-free asset, right, then that's where you put all the money, and you'd end up with a straight line, right? It's kind of how it works. Now, in practice, that's not possible to do, right? And so what you end up with is on that same graph, you end up with a scatter plot of different assets all over so on the x and y axis, you've got risk and you've got reward, right? That's the graph, right? So what you end up with as you accumulate assets, you end up with them scattered all over the graph, right? Based on their risk and reward rate, okay? And then what you get when you group them and draw a parabola around them is you get your efficient frontier, right? So the idea in any portfolio is to establish the most efficient rate of return relative to the risk. Okay. Now, efficiency or the efficient frontier is something that I really want to talk about in this, right? Because the efficient frontier comes down to not just the efficiency of the return, right? But it also comes down to the efficiency of the capital allocation, right? And that's why capital allocation is a key component in the risk-reward modern portfolio theory matrix, right? Now, so can you buy properties that are, let's say, $100,000 that are great properties to buy? Well, the answer is yes. Now, define great, but in the context of this, what we're talking about is properties that are going to perform well. We'll just kind of broadly say that, right? Can you find properties for $100,000 in Australia that will do that? And the answer is yes, you can. Does that mean that you should buy all of those? Like your portfolio should consist of all of those type of assets just because they're cheap? No, you absolutely should not. So can you also find properties that are over $1 million that are great assets to buy? Yeah, absolutely you can. Does that mean that your portfolio should consist of all of that? No, it shouldn't. Okay. And so what is really important to understand is the portfolio mix, right? And so one of the big problems with real estate, generally speaking, is it's highly illiquid, right? And most people get it wrong. Now, the most people getting it wrong part is interesting for a much bigger reason. And that is because 90% of property investors never get past 2 properties. Very hard to build an efficient, diverse, balanced portfolio with 2 assets, right? It's like you pretty much can't do it. And that's kind of the problem. So the goal should be, okay, how do I position myself so I can accumulate more assets, because more assets equals more diversification. But then how do I think about those assets in a broader context of my portfolio, right? So from a capital allocation perspective, it costs you more money relatively to buy a cheaper property. And the reason for that is some of the costs are variable, but some of the costs are fixed. So whenever you've got fixed costs but variable prices, that then changes the return profile of the property. So conveyancing is going to cost the same. Building and pest is going to cost the same. If you're working with a company like Dashdot, that's going to cost the same. All of this kind of stuff. So you have all these kind of fixed costs, and so the relative amount that you might spend on a $100,000 property might be, I don't know, maybe 25, 30% of the property value to buy the property, but using the same, structures and everything like that to buy, I don't know, a $2 million property, it could be like 9%. I don't have the numbers in front of me. So you have a capital efficiency basis, but you also have a risk and a return profile change. So I know I've waffled on a fair bit there. Do you have anything you wanted to kind of interject there?
Yeah, we absolutely have to break this one down. We're going to wind this one back, and you've actually made a few points there. So in practice, if we were going to describe modern portfolio theory, I believe that's what it's called?
Yes.
Okay, so we're an Australian property investor and we want to apply this thinking in the real world. Yep. What we're suggesting here is that the optimal way to do a portfolio might be that you have $1 million asset and then maybe 2 smaller assets that offer the diversification or difference. So maybe it's, to use an example, you might have a blue chip property in Melbourne, and then you might have something more regional in other parts of the country that come with more risk, but potentially more return. So we're playing this balancing game of this scale almost to get the best returns, where if I was to, again, just to use your example, if I'm only going to buy $1 million blue chip assets in Melbourne, I'm going to get stuck for other reasons and be very limited on how far my portfolio could go or the potential returns to come with that.
Correct. And there's a few different vectors to that as well, because the technical terminology for that kind of, like, if you imagine all of your assets as a scatter plot on a graph, right? The technical term for that group of dots, right, is the opportunity set, right? So it's not about saying, all right, what is the specific formula of things that I need to achieve? Okay, I need one $1 million property that yields at 4%, and I need one $100,000 property that yields at 8%, and I need one $450,000 property that yields at 6%. It's not actually about doing that. That maths won't work, right? Because the opportunity set is specifically based on the assets that you can acquire in the current environment with the current constraints that you operate with. Okay, so if you said to someone, hey, Charley, the best portfolio combination for you is to buy one $100,000 property, one $1 million property, and one $500,000 property. But if they only have enough money to buy one property, well, you know, like maybe they can't buy a $1 million property, for example. And so you've really got to adjust what the opportunity set looks like based on the right combination of assets and characteristics. There is another layer that goes into this, which is from an efficiency and a risk perspective, one of the risks that people face is stalling their portfolio. So it's not just about environmental risk. So it's not just about saying like, oh, okay, so I can buy one blue chip property and then I'm going to buy one like high risk property in a mining town, right? There's actually other risks that you've got to factor in there. So one of the biggest risks, as I pointed out, is that people don't get past number 2, right? Most people don't get past number 1, right? So, in fact, the biggest set of property investors is people who've never started there at 0, right? So that risk is real as well, and so you've got to calculate that risk too. It's not just about the return profile or the perceived environmental risk. It is also about the continuity and liquidity risk that you face. Because, for example, let's say that you bought 2 blue chip assets, and let's say you were lucky enough and affluent enough to be able to do that, because most people can't do that. But let's say you did buy 2 blue chip assets, but unfortunately that meant you had no borrowing capacity left, and therefore you couldn't continue to buy any more properties. And therefore, also, even if those properties did go up, let's say that they grew really well, and all of that kind of stuff, but you couldn't actually use any of the equity because you have no liquidity. That's a risk, because all of your capital has become siloed and stagnant, and therefore you have opportunity costs. So understanding risk actually is a bit like an onion. But yes, so essentially what I am saying is that you do have that risk profile analysis. So for example, when most people are starting, typically they're low on capital but high on borrowing capacity. Typically, okay. So the thing that they need, the thing that their portfolio needs more of is capital appreciation, but they also need to do it in a cash efficient way so they can maintain liquidity. So there's a few other layers that go into it.
Yeah, so this is in your book. You've got a fantastic chart about the base stage, then you've got the acceleration stage, and the legacy stage. It does tie into that. Shameless plug for the book. You should go buy it and read it if you haven't, and listen to this podcast. Okay, I really resonate with the idea where the biggest thing that stands out is personal, right? It's actually you in this circumstance. So like the difference between myself and then someone who's got $1 billion of capital behind them, it's like this game is completely different when it comes to what their right portfolio mix would be. So when we're listening to these, again, coming back to the question, only buy 400, only buy properties at $1 million, is that it's such a blanket statement that if you were to act alone on that without taking personal circumstance or potentially getting some advice, that it could potentially leave you in a hole through not thinking these things through. And again, to use your examples, if you went all million properties, you followed this advice blindly, you get caught in negative gearing, borrowing power destroyed, stuck for 10 years, or you have to sell. Other side of things, you go all $100,000 properties, you end up in a property management mess. You end up with 50 of these things and you've got tenants calling you every day, or property managers, or whatever it is. Like there's really the opportunity to swing too far, or you're all in mining towns, or whatever it is that potentially could run you a mess there. So where would you, I'm almost like, I'm not sure how to frame this, but where does someone start with this? Like, how do they approach this?
So just to touch on that point that you made, it is highly personal, right? It is highly personal, which is why I will absolutely say that anyone who takes a dogmatic approach is someone who is getting it wrong inherently, right? So that's why that is wrong. It's not to say that the things that they are saying are specifically incorrect, that different properties will perform whatever, but it's that it cannot, by definition, it's a dynamic equilibrium is what it is. So where do people start with it? Well, it really, I don't want to like distill this down into like super basic stuff, but it totally depends on where people are at financially, spiritually, emotionally, all of that kind of stuff versus where they're trying to get to, right? Someone could have a high EQ and FQ, and a high risk profile, and they could be like, right, I understand money, I understand what I'm doing, I'm like, I've got a high level of emotional intelligence, I understand my risk profile. I think maybe an entrepreneur, a business owner probably fits that category.
You definitely described that pretty much.
Yeah, exactly, right? Exactly. Now, that great, awesome, right? But we also then got to go, okay, well, how much capital have you got, and how fast are we going to go, and like, what is the end goal, and all of these different things matter. They all matter a lot, right? So look, generally speaking, broadly speaking, we do tend to find that because what we do for most of our clients is a balance of risk and return. So it's not on the peripheries of either. And so the peripheries of the risk return profile are things like blue chip and are things like, mining towns. Okay. And they have a place in a portfolio, right? They absolutely have a place in a portfolio. But for most of our clients, because you've got to remember that, as I mentioned earlier, the largest set of property investors are at zero. They haven't yet started. Right. The second largest set is at one property, and the third largest set is at two properties. And after that, the drop-off rate is just so tremendous, right? So when you're starting out, finding the optimal balance is probably more important than trying to find the extreme outliers. So rather than going, okay, I'm going to pick two ends of the spectrum, and then my efficient equilibrium is going to be somewhere in the middle, it's actually probably better to try and aim for the middle, right? And then expand outwards. I tend to find that is it's a much more structurally sound way to approach it, because you can build a platform, which is why we talk about, in the Apex progression, which you mentioned in the book, we talk about things like building a foundation, building a base, right? That base is typically going to be on a balance. It's not going to be low risk, and it's not going to be high risk. It's going to be like medium risk, and it's also going to be like probably medium return. It might not grow as fast as a mining town location, but also it's probably not going to crash like that either. And you got all these other things. So it's kind of balanced. And so I think starting in the middle and building that out, because in that way, even if something changes, right? You might lose your job, you might, I don't know, move overseas, or you might, just stop wanting to invest in property. Then at least in that scenario, you have a portfolio which will be sustainable and, will have resilience and will be a good long-term decision without having to operate on the peripheries, where it could cause you stress and risk in a variety of different ways, whether it be cash flow negativity, you're feeding the beast, or any of these other kind of things. So my view is to start in the middle. And then once you build a platform, then you can start to expand from there. And I've had loads of those conversations with our clients who we've helped to build that platform, and then have they're now standing on the platform and they're going, okay, well, I achieved that thing that I set out to do, and now what? And that's where the conversation then goes to, okay, so now that you've got the base, well, let's actually start thinking about some other things. And depending on the profile, financial, emotional, and that kind of stuff, that then dictates where you want to go next. And so if you've built the base and then you've got, I don't know, tons of cash flow from your business or whatever, but low risk profile, and you're playing a 30-year game or whatever, well, maybe the next step from there is to actually go buy maybe a blue chip something. If you want to go in another direction, you can view in another direction, and then you start to expand it, and then you start to build that efficient frontier.
Yeah, I love the thinking behind this so much, and it's probably something not spoken about broadly. And I get it, right? A lot of these companies out there, or people that work in these industries, they've built a brand around a tactic. So, it's a rooming house person, or a cash flow person, or a blue chip person. So if they start saying this, it kind of goes against what they've built resonance with their audience. And to the point is, many of these people have actually been astronomically successful following that, which I think is where things get more interesting. But I want to jump into the next question here because it ties into this nicely and something I've been very, very curious about myself. In the past 12 months, at least, maybe even longer, the broad message in the market is that units and apartments are trash. They're falling down, the construction's dodgy, the CBDs are empty. Like they have I don't think there is a more hated property asset in Australia than Melbourne apartments right now, CBD apartments. Like they definitely are being, I don't know if it's unfairly, maybe it is fairly. But what I would like to know, Goose, is do you believe that units and apartments will ever have their day again? Are they even worth considering at some point?
Yes.
Interesting. Can you expand on that?
Why? Yeah, I can. Of course, I can expand on that. So the thing is, look, we talk about this all the time, right? So our general thesis for clients that we work with is that we buy houses, right? Detached, standalone houses, not apartments, not townhouses, etc. Right? Because generally speaking, all things being equal, houses will grow more than townhouses or apartments or units. Now, we also buy duplexes, which is 2 units stuck together. Okay, so we kind of actually are buying units as well. We also buy apartment blocks, 3 packs, 4 packs, up to 6 packs. I think is the big 6 packs the biggest we've bought, right? So we're buying units. We're just buying them in a coagulated mess or lump. Not a mess, a block, right? An asset block, Charley. Actually,
shameless plug for the new podcast.
Yeah. If you're interested in learning about Charley's podcast, where they go, Charley?
Assetblocks.com.au or search the podcast stores.
Perfect. Awesome. So the thing is, we are kind of buying units anyway, but the general thesis is houses will outperform apartments or units. So for the simplicity of the discussion, we'll call them units, right? And we'll use that as a broad categorization of all of those. Basically anything that's submitted that is part of a strata plan or anything like that. Okay, simple. Now, if you look at the maths, generally speaking, houses will outperform units. That's just the facts of the growth, right? There's a whole bunch of reasons for that. However, like I said earlier, about the people who have a dogmatic approach to property strategy or whatever, that can be generally true, but it's not absolutely true, right? So there are plenty of markets that exist where units are outperforming houses pretty much all the time. Like pretty much, not that they're outperforming all the time, sorry, but at all times, there is probably at least some locations in Australia where units are outperforming houses, right? And there's a variety of different reasons for that. It could be lifestyle, it could be affordability, all of this kind of stuff. Generally speaking, as our population changes, there is a propensity for people to want to live in apartments, partly because of affordability, but also we have what we call the loner effect, right? Because traditionally people would young people would grow up, they'd live at home, they'd stay living at home until they found their life partner, then they'd move in with their life partner and then they'd start a family. So they basically so they get married and then they move into like the family home and start a family. That was kind of the more traditional model. So you had family units staying as a family unit until that family unit went and created another family unit. And so the demand was consistently for houses because it was a family home to another family home. Now, as the way that we live has changed and more people are staying single for longer, so they're moving out and doing all that kind of stuff, the demand for space is not the same as it was, right? Which is good because we just couldn't sustain that level of housing growth anyway, which is why there is, broadly speaking, a greater trend to apartments and more condensed living and all of that kind of stuff, because you also get the affordability or that kind of level of efficiency as well. Now, the problem comes with supply. So if you look at places like Brisbane and Melbourne, where there's been oversupply issues, that's a problem, right? So that's where it can have a negative effect if there are. And, with apartments, the sky's the limit, right? Quite literally. So that's where the problem comes into it. Now, there are other markets, though, where the supply is constrained, either through deliberate council planning or through, for a variety of different reasons. And so apartments can outperform houses. And I know that I'm pulling a lot onto the table here, but I want to try and get it all out and then we can dissect it. The other thing to consider in the context of what I was talking about earlier, modern portfolio theory, is about the efficient frontier, okay? Now, you can find often that apartments or units may produce higher yields, and in many cases, higher net yields, even after strata fees and all of that kind of stuff. So depending on where your portfolio is at, you may actually reach a frontier where adding apartments into or units into your portfolio makes sense from a cash flow perspective, right? So to give that some color, let's say that you have built up a portfolio, you've got tons of equity, and you've kind of like already built that base. You've got the base. All right, I've got the base. It's growing. I'm happy. If I do nothing, I'm good. Like that's when you know you've got the base. It's when you can hit save and say, if I do nothing from here on out, life's sweet. That's the way I see it. If you get to that point and then you go, you know what? I just want to like pump it all. I'm going to start buying like cheapy apartments all over the place that are like 8, 9, 10% yield, all that kind of stuff, then that can make sense too. And so, again, generally speaking, we tend to prefer to go towards houses, but that doesn't mean that apartments don't have a place in a portfolio. And also, apartments and units can outperform houses depending on the market conditions. So maybe let's pull that apart.
Okay, so I just want to. I almost think that's a deeper question I'll ask on this, but I want to go back to something as well. All right, let's say you're in the beginning of your journey and there's the option to buy houses or apartments. In general, houses have done better from a growth perspective. Yes. And apartments have had some challenges, as the media has said. If you went hard on apartments early and didn't get the growth that came from houses, you're basically setting yourself up to make the next moves harder because you wouldn't necessarily maybe have the equity to do so. Correct. You may have some better cash flow. So that may be a different advantage or way of doing it. So that's the like general premise. But later on, if you've got that foundation, this might be a way to crank the overall yield on the portfolio or use equity to maximize it.
Yeah, yes. And to that point, where most people go wrong is that they think, I want to start investing in property. Apartments are cheaper. I will start by buying apartments. And they hit that exact problem. I know Jason, who's on our team and who's been on this podcast before, he had that exact problem. Like he literally had that exact problem. He bought an apartment. It was a really bad, it was a total nightmare. We actually had someone reach out to us recently and they have bought, I can't remember, they bought a number of really small apartments, like studio apartments, but they're less than 50 squares. And so the cash flow on him is like ridiculously good, right? But he can't refinance any equity out of it because the banks don't like it and all of this kind of stuff. And he's like, well, what do I do now? Like, do I just need to sell them all and start again? And you know, kind of. I mean, if Charley, we had a fractional property liquid real estate exchange, which, you know, just seeding that in this podcast right now might be something that's coming in the horizon, then that individual might be able to sell off a fraction of those, keep some of the cash flow and liquidate it. But in the current state of the environment, you're probably going to sell the assets. So this is why it's important to think about how you're building the portfolio, the structure of your portfolio as you go, as opposed to acting on your emotions and all of that kind of stuff. Because to your point, if you build up the equity base first, then start adding apartments and stuff later, that is a much more congruent way of doing it, because you'll keep moving in the right direction, as opposed to starting at the end and trying to work back. It doesn't work.
This is one of those interesting things where it's like it opens a deeper topic about, I don't think people realize that the debt you get in investing property investment isn't all equal either. Yeah. So it's like if you get some debt tied up in that studio apartment under 50 squares, like that borrowing becomes, I'm going to say like a semi-liability. Yeah. Because of how it's unfavored with the banks for future moves, where it's like if you've got blue chip property debt, like especially if there's a heavy amount of equity, the banks love it. They know they can feel very certain that. And I even think, don't quote me on this, but there's certain towns that the banks won't even lend in to the same level.
Yeah, totally. Yeah, they risk rate different towns and stuff like that. And all of that factors into your portfolio decisions, because again, one of the biggest risks is that you get stuck.
Okay, well, one more thing I just want to bring into this. I want to imagine that from here, so from today, houses grow at 10%, which again, I'm laughing because it's like, if you said that 3 years ago, Goose would have been like, yeah, right. Last few years. Totally. Yeah. Anyway, and apartments grow at 5%. So there's a divergence. Yeah. Okay, so this splits off. And then we're 10 years later, and that has occurred. Surely at some point, there's got to be something where people look at the value, and that value exchange is just such a better comparison where apartments will have their day. Do you see that happening or not?
I think that really depends on your perspective, right? So a different way to think about this, to probably give it some context, right? Because wealth is awesome, but cash flow is king, right? So you want to build wealth so that you've got a stable base and so that you can essentially start converting that wealth into cash flow. That's for most people. That's the goal. So if you level up your thinking and if you imagine you're $1 billion investment fund, like, I don't know, like Blackstone or something like that, they don't invest for growth. They invest for cash flow, right? They get some growth. So they buy commercial assets, which historically perform worse than residential assets in terms of growth, right? But they're buying it for the yield. Now, the reason that they're buying it for the yield is because they've already got the capital. Like, they've got $1 billion, right? And so depending on where you're at, that's what's going to matter most, because you also got to remember cash flow increases over time as well, right? So if the rate of growth in rents is 5% a year, that's 5% on 5% on 5%, it compounds as well, right? So your cash flow goes up. So that's where you need to think about where that sits for you. If your goal is to build the greatest amount of wealth because you're going for like a multi-generational play, then yes, taking that kind of like 20-year time horizon with a 5% divergence a year, it might make sense to try and go more for growth. However, if your goal is to retire on the most amount of cash flow, then you may take one path for a certain period of time. I don't know, 5 years or so. Maybe you'll go, right, we want to maximize our growth opportunity for the first 5 years of the portfolio. We want to smash it. We want to get to like whatever, $3, $4, $5 million of available capital in our portfolio. And then you might just go pump all of that available capital into high cash flow assets, which are going to give you the liquidity that you need to be able to take that money and reuse it, and also to give you the income that you need for the rest of your life, and also do it in a diversified way. Because you've also got to remember, if you do it like that, so let's say you start building a portfolio and then I'm using 5 years, but who knows what it's going to be for you, right? Let's say over 5 years, you get loads of growth and you build up a huge big capital base and you got loads of equity and it's wonderful. And then you then start taking that equity to go and buy cheaper assets, which are units and apartments typically and stuff like that. You're probably going to buy more of them. So let's just say you've got 5 properties in your portfolio to that point, and then you start to diversify. You might be able to go and buy 5 or 10 apartments, right? And all of a sudden, the diversification in your portfolio is broader as well. And so you're diversifying your risk, diversifying your income streams, creating greater stability so that you don't have just like 1 or 2 or 3 or 4 or 5 income streams coming from your portfolio. You may have 15, in which case the risk of loss of income through like rental vacancy or stuff like that becomes diminished as well. And so that then again lends into the efficient frontier on the risk reward profile as well.
Such an interesting topic. This is the other side of it, right? And I'll come back to the start of this conversation in general, is like when you hear these blanket statements without making them situational, it's like for someone that might actually be the greatest move ever for them right now to just go hard on apartments.
Yeah. Look, I'll be completely honest, Charlie. Like I am actually kind of looking forward to the time where that makes sense for Gabby and I. Because I think it'd be awesome, which like go and buy 10 or 15 apartments once you've built the capital base, right? And so it makes sense at a certain point in time, but it's really, as you said, it's personal. You've got to think about this. Like there is other stuff to it, but it does and can make sense. So to your point, will apartments and units have their day? I think in every portfolio, there is no such thing as a bad asset. There is just bad asset selection.
It's so interesting, Goose. It's so maybe apartments are already having their day. Should have reframed it. But I find your comment interesting about looking forward to that point. Is like I must say this is something that comes up for me. I see these small purchases, let's say it's 200 grand or something, and I just go like, that's just not going to have a big enough impact. I look at it and go like, when you buy $1 million asset, and this is complete ego, by the way, it's unfounded in reality. I get that, but there's a subtle joy in buying something for like $1 million. It just feels like you got a lot done. It's like a good day's work.
Yeah. Yeah. And again, there is a capital efficiency piece there as well, right?
Completely.
So swings and roundabouts.
Alrighty. Well, I want to jump into our next question here because I feel like this is ties into this topic. I love how it all ties into the same theme here. Something that I've noticed immensely is that properties have stigmas, and they can be good stigmas and they can be bad stigmas. And I'll give you an example. Is once upon a time I used to live in Brighton, Victoria, which is quite an affluent suburb. And it would surprise me when we would go out for dinner, maybe with some people, or we would go to a party and someone would ask where I live. And if I said Brighton, they would change. Like their demeanor would change. they would be like, "Oh, well, you must, be doing well," or something of that nature. I was just a house. Reverse of that is that, there's areas that come up, and I'm going to label 3 here: Logan, Frankston, and Mandurah, which is in Perth. And hopefully I've said that. Is it Mandurah?
No, it's Mandurah. You got it right. Mandurah.
Now you look at those 3 suburbs there, and if they get mentioned in a Facebook group, like, it explodes in polarization of, like, basically high crime rate, high unemployment. It's the end of the world. Your house is going to get stolen, wheels off your car. And, like, I look at that and go, but is it a good investment? And I've been very curious from your perspective how stigmas do. Like, are these stigmas advantages because maybe a lot of investors won't touch them? Have they performed well or not well? What's your view on this?
So I have probably unsurprisingly some established and potentially contrarian views on it. So firstly, when the facts change, like, so there's an awesome quote it's either from Winston Churchill or John Maynard Keynes. No one can ever quite work it out, but it's when the facts change, I change my mind, right? And that is really important for any investor to remember. So there are locations that we are currently looking at buying for our clients, which if you go back through our podcast episodes, you would hear me specifically, canning out those areas for valid reasons at the time, like for valid reasons at that time. But things change, environments change, inputs change, all of that kind of stuff. So you need to be able to remain limber.
Can I just jump in on one that I see is, like, if you were to go back maybe 3 or 4 years ago, before the migration to Brisbane, okay, and you looked at an area like Logan, which is, like, potentially maybe not doing well at that time. I'm making it up. I don't have the facts. But then 43,000 people net migrate to Brisbane, and all of a sudden there's a massive economic push. There's massive infrastructure projects, which could be, I don't know. But anyway, that whole environment and landscape has changed. Where supply and demand is just shift. Everything's been taken. That would be the type of event or fact change that would have changes in investors.
Correct. Yeah, correct. So it's usually a combination of demographic, psychographic, and economic factors, which change the facts, right? Now, the problem with most investors is they make bad decisions. In fact, let me just expand that. The problem with most people is they make bad decisions, right? And the reason they make bad decisions is that most people don't make logical decisions. They make emotional decisions and then try and back it up with logic, right? This is the fundamental problem that most people have with decision-making generally, and property investors specifically have this issue, right? Because they will have an emotional view on a location or a strategy or whatever, and then they will try and support that by finding facts that support their decision. So you can find facts that support anything, and when you do that, it's cognitive bias, right? And this is the underlying reason why I think most people don't get what they want, particularly out of their property portfolio. Like I think one of the biggest, saddest things about property investing is that most people never actually get what they want out of their portfolio. Most property investors are obsessed. They're like a pack of weirdos. If you're listening to this, you're one of them too, probably, right?
It's like they're people that go to the personal development events, but never they love going to the events.
They
never turn into the person they wanted to.
Exactly. They do all the stuff, they like do the thing, and they think that if they just love property enough, if they talk about it enough, if they're in enough Facebook groups, if they scroll.
Ease up. This is a good portion of my life.
No. But they think that if they do that, that is the thing that will give them success, because somehow they will synthesize, some arbitrary thing. But at the same time, they're not prepared to adjust the way that they think, and they're still acting on the basis of emotion, right? So the other thing to consider, so there's that. So just to reiterate this, because it's a really strong point. Most people don't make logical decisions. They make emotional decisions and then try and support it with logic. That is cognitive bias. That is the problem that most investors face. Now, moving past that and then talking about locations specifically which do have stigmas and how that can change, that can actually be a great growth driver. And in fact, Gabby came up with a funny theory once, which is, we haven't yet proven it to be true, but I call it Gabby's Commodore theory of growth. And she believes that if you find locations that have got loads of Commodores parked on the front lawn, that's probably a sign the area is going to grow, right? So which is interesting because if you actually break it down, what you're talking about is gentrification. You're talking about demographic shifts, psychographic shifts, and all that kind of stuff. And some of the greater, like there are a variety of things that drive property markets, right? But psychographics is probably one of the biggest ones. And if you look at any area, like when I was living in Melbourne, for example, I was living in Richmond initially, and then Richmond started getting, gentrified and more expensive. Rent started going up. So then I moved around to Fitzroy because that was still grimy and grungy. And then that started gentrifying, and the rent started going up there. And then I moved around to Footscray, and then like the gentrification moves, and those areas which once were bad areas become very affluent areas. So if I think of Yarraville specifically in Melbourne, like I've met property owners right there who bought their property in Yarraville for like 50 grand or 75 grand or something like that. And now that same property is now worth, multiple millions of dollars because the environment has changed, right? And so moving past that stigma to look at the facts, I think is one of the key things for people to understand. And you've got to be prepared to say that there's a saying is a French phrase that I know from my French friend Julian, right? He tells me all the time. He said, "Only idiots don't change their mind," and I think that is so true because you talk about Mandra, you talk about Logan, and I can't remember the other one that you mentioned, but yeah, look, maybe that viewpoint about it maybe being lower socioeconomic demographic, potentially not being a good area to invest, all of this kind of stuff may be true. Even the demographic profile may still be true right now, but that doesn't mean that it's a bad place to invest. So looking beyond that, I think, is the key. Oh, sorry about that. My podcast equipment fried itself, unfortunately. So something happened. Something happened, and it was switching on and off, and my computer was trying to flip between the two. So we had a little bit of a technical issue there. So I missed that awesome soliloquy that you had. Do you want to give me the kind of cliff notes?
Altona, I thought it was haunted because of the abattoir in Melbourne. It was a story around like, you got to be careful, like bad things have happened here. And then I've been there more recently and it's like beautiful. And I have a friend who doesn't live far from Mandurah, and he's like, "What are you talking about? It's a dive. There's beautiful homes here."
Yeah.
Like, you talk to the people in the area, some of them, and I'm sure there's opposing opinions to that, but it's funny how these stigmas, and I think you made a really excellent point about it changes. It really does change.
It's so funny you mentioned talking to the locals, right? Because I remember talking about this specific angle around about 2-3 years ago nearly, right? Because talking to the locals can be really revealing, but it can be on both sides. Because sometimes when you talk to the locals, you'll discover that things aren't like the stigma, like in Mandurah. Like they'll be like, "What are you talking about? It's beautiful. There's nice beaches. The houses are nice. There's good stuff here. It's a great place to live." It's like, oh, that's contrary to the way that I was thinking. But also, sometimes when you speak to locals, you can discover that they also don't know what's going on, and that can actually be another competitive advantage as well. So if you have enough facts to tell you or to point to the fact that an area is about to grow, but then you speak to some locals and they're like, "Oh, you wouldn't want to live here. Nah, it's no good." That's probably a good sign, because you're probably going to be able to get the property prices for cheaper and less than their intrinsic value. So understanding all of that kind of stuff and understanding those variables, I think, is a key to making good property decisions.
Yeah, awesome. I just think of one more. If Elon Musk was building a mega factory in Mandurah, for example, and I'm not picking on that, I'm just saying it's like that would be another thing that would radically change a suburb, if a big event, or an Amazon factory or another one like that could be a big thing as well. But Goose, you've answered all my questions today, and I know a very in-depth understanding of these topics here. So thank you for having me on again, and thank you for, I suppose, letting me pick your brain on these very important issues.
I loved this, right? Because things like modern portfolio theory, the efficient frontier, stuff like that, I love it, right? And this is, I think, a side of investing generally that people don't think about, full stop. And it's definitely not a topic that is discussed in property investing, because I don't know why, but I think it's a really great platform for us to be able to talk about this kind of stuff. And yeah, it really kind of underpins the thinking behind all the stuff that we do, particularly everything that we talked about today, even making logical decisions, not emotional ones, and how to think about structuring your portfolio really plays into the heart of what we're trying to help people do. Like fundamentally, we want to help transform the way the world invests so that we can improve the lives of all of the people that we touch. That's really a big part of what we do. But doing that means we all need to change the way we think, because the way that people invest in property is broken. It doesn't work. You've got to do it differently to get different results. So, Charley, I've really enjoyed this chat. Thank you so much. Thanks so much for your time. Really, really appreciate it. Great questions. And I look forward to speaking to you again soon.
My pleasure, Goose. See you on the next episode.